The trading range, a big deal, not well understood. If you viewed the competitive positioning video, you know that the secret to getting the highest price in the shortest period of time is positioning your listing to be the next best one in that market segment, all things considered. Taking it one step further, we want to competitively position within the trading range. So what's the trading range? In real estate industry speak, the trading range is simply the list to sales price ratio of a group of like properties. More specifically, it's the difference between the average asking price of those listings at time of sale versus what they actually sell for. The formula would be average list price minus average sales price divided by average list price. You don't have to worry about that, more on that in a minute. To be clear, we're not talking about the original list price, rather the list price at time of sale versus what they actually sell for. The reason I've coined the term trading range is because when you look at any group of like properties and take the average amount sellers have to come down from the listing price at time of sale to the actual sales price, that difference is almost always within a 2 to 5% range, the trading range. You'll find exceptions, for example, in the very high end, but they are the exception rather than the rule. Also, the tighter the range, the hotter the market. This is hugely significant. What it says in a word is how efficient the market is. The market is remarkably, really almost stunningly efficient. Think about it. In the retail world, there's a phenomenon called perfect pricing. Perfect pricing refers to the fact that you can go online and in seconds get the best price on the planet for just about anything. Perfect pricing. However, you're comparing apples to apples, widgets to widgets. In real estate, you're never comparing apples to apples. Even with production homes, where two homes might be identical in floor plan, elevation, quality of improvements, etc., you still have a unique lot with its own unique characteristics, lot size, orientation, location, etc. It's fundamental to the very nature of real estate that no two homes are alike. Even more so when you get into issues of semi-custom, custom homes, not to mention differences in home's condition, quality of improvements, and on and on. So for residential real estate, with all those inherent distinctions, to trade within a narrow range of 2 to 5% is truly remarkable. Much of the credit, of course, goes to the MLS, the multiple listing service, giving thousands of potential buyers the opportunity to view and compare all their choices all at the same time. You see the tie-in with competitive positioning. When all potential buyers are effectively competing for the best properties in any given market segment, that competition drives market value, which again tends to end up within a narrow range. This is easy to prove, by the way. Just look at any CMA you do in the MLS and you see the list to sales price ratio or trading range. In this example of a Flex MLS CMA, we see the math is really done for you with the average 97% average list to sales price gives us our 3% trading range in this example. Even more broadly, when you look at entire zip codes, we see the same phenomenon. Notice how even in Paradise Valley, zip code 85253, where the average sales price is over 1.2 million, we still have a trading range of 5%. Now, it's not that we don't see this information, it's that I believe we fail to see the significance and the implications. For example, if I'm a seller armed with this information, I'll understand that pricing outside the trading range for my particular market segment is effectively spitting in the wind. I'm not in the game until I'm priced within the trading range. Similarly, if I'm a buyer armed with this information, I'll understand that when a desired property is priced within the trading range, a lowball offer is most likely not going to work. It's only going to offend and thereby psychologically compromise my ability to get the best price obtainable for that property. On the other hand, making an offer lower than the asking price but within the trading range is something that can be justified. My agent can make a credible case for acceptance. Now, we know that when properties aren't competitively positioned within the trading range in their original offering or the original list price, they're setting themselves up to become market-worn, perceived by buyers as having something wrong with them. They've been in the market too long, or at least longer than average for that market segment. Further, they're going to miss the best activity, which is that early activity, where the educated, motivated buyers come to understand that the best properties won't sit in the market. So they need to move on them quickly and just hope that their offer is not in competition with other motivated, educated buyers. So the trading range really is a big deal, if not well understood. And the takeaway here is that there is a narrow trading range. It's present in all markets, 2 to 5%, all market segments, and even all market conditions. The market is incredibly efficient. And therefore, it's a phenomenon that should be part of our discussions with both sellers and buyers to help them better understand the dynamics of the market, to help them achieve the most satisfying outcomes.